looks like we could have an absolute debt crisis on our hands, and it could have massive ramifications in the real estate market. But many are suggesting that this could be a little bit of a mirage and that Canadians can completely deal with the upcoming quote-unquote debt crisis and increasing mortgage costs. We're going to touch today specifically on what to expect when it comes to mortgage renewals looking into 2024, and why most banks are actually saying that despite the fact that the cost of borrowing is going to go up for years, people are going to be able to make their mortgage payments. So let's get the facts right. What's interesting to note is that in 2024, about 14% of Canadians will have their mortgages coming up for renewal. As you know, that's nothing compared to what we're expected to see in 2025, in 2026, when all of those COVID year people who picked up low interest rates are going to be renewing their mortgages. So it will be another year or two before we see the major change in interest rates, but the banks are still very optimistic about people being able to make mortgage payments and not entirely concerned about a massive impact on the real estate market. Now, really for today's conversation, we want to focus in on why we're expecting to see not only the cost of borrowing increase for the next couple of years, but in addition to that, the fact that mortgages themselves are going to go up and Canadians are going to be able to manage those monthly payments. To really get into it right off the bat, talking about the actual cost of borrowing is key. Over the next couple of years, Canadians are going to deal with rising mortgage costs. No matter what you do, you can't get away with it. If your mortgage is coming up in 24, 25, or 26, you're going to see a higher interest rate than when you began, with the only exception to that potential rule be the fact that people who took variable interest rates would have slid their mortgage payment up or down to be similar to what they would have been paying either way before. Before we go any further, guys, as I have to ask, make sure to hit that subscribe and that like button if you're liking the information on this channel. And of course, leave a comment below with any questions or feedback on what you've seen today. Now, before we get into it, really quickly, in this article recently from BNN, Canadian mortgage holders can cope with loan renewals. The banks were suggesting that not only are people going to be able to make the payments, the average monthly total cost increase when it comes to mortgage payments and the mortgage interest is going to be about a $5,000 difference based on the loan amounts that they've got on their books. What's also not surprising but interesting to note is during a survey of many Canadian mortgage holders, they're more willing to cut discretionary costs like going on vacation and other discretionary spending than miss their mortgage payments. Now let's take a step back. The average Canadian over a long time has been more willing to pay their mortgage payment than anything else. We have some of the lowest default rates in the modern world, and one of the reasons for that is because we have pride of home ownership. And so it's probably not unlikely to assume that that's actually true. I've definitely heard of stories where people were almost willing to sell almost anything, car loans, credit cards, everything they have in their house, get rid of it all in order to make sure that they continue to make their mortgage payment because it is so valuable to them. Notwithstanding the fact that rental rates has significantly increased over the course of the last 2 years alone. So it's become less and less and less enticing for someone to consider the possibility of selling their property and actually renting, even though we've heard stories of that happening over the course of the last year. Now, unless you've been hiding in a rock, you've probably also been aware that many of the economists are essentially predicting not only the Bank of Canada, but just generally speaking, fixed interest rates to decline over the year 2024. Now, with most mortgage interest rates set to come up anywhere between the hot months of May and October of this year, it's very possible we'll also see decreased interest rates from the current highs of the 6% range, probably down by around 0.5%, even 0.75% towards the end of the year. Now, that is going to have an impact on people's ability to make monthly payments. Now, in this article, the banks indicated, specifically RBC, that they expect the average increase to their monthly payment to be around $400. Now, it doesn't indicate specifically whether or not they're considering whether the client has decided to refinance, extend the amortization, what type of loan term they're looking at, but that's probably not shocking to see those numbers. During a recent video I posted, I actually showed the math on how actually if you were to use a re-extended amortization from someone who started from 25 years when they were up 5 years ago, they could actually make it so their payment was within a couple $100 on a $500,000 loan. We'll post that video below so you can reference that in the future. Now, ultimately, this video is really about whether or not people can make the payments and what the banks are indicating as surveys suggesting most Canadians can do so. Ultimately, I don't think this is another video where I'm suggesting you guys can make payments and don't worry about it. There's definitely some truth to the fact that there's going to be a lot of pressure on Canadians to be able to make their mortgage payments, but honestly, in my experience, I found that most people are pretty darn resilient and they put themselves in a position for success when they have the opportunity. I think the biggest thing that people are concerned about is that ability to re-amortize or refinance. And there's a lot of people out there saying, well, people can no longer do that. They don't have enough equity. But remember this, the average Canadian consumer who's coming up for the mortgage renewal in 2024 probably took a 5-year fixed mortgage. And if that's the case, that means they bought their home in 2019. And so if we're focused on most major cities, Vancouver, Toronto, or any of the other major cities, you've seen people increase the value of their homes and therefore seen equity increase dramatically. And based on the assumption that these people have not refinanced their mortgage during COVID because they still have a mortgage term in place, it's very likely to assume that they can actually restructure or refinance. Therefore thinking, hey, listen, most of these people have options, and if they are concerned, there are some backup plan solutions that would be available to them. So another train of thought is, well, hey, if there are a lot of people out there who have these mortgage renewals coming up, we're going to see a ton of homes come to the market because people aren't going to be able to make these monthly payments even after they looked at restructuring because they have so much debt or they're underwater. And while that could be possible, I think one of the biggest considerations to remember is that if somebody's selling $1 million property, their actual cost to sell that property could cost them $50,000 to $60,000 as opposed to working out different options. And so you're definitely going to see that come into play when they're considering, notwithstanding the fact that it could be really hard to get back into the marketplace. So for those who think that the people will see a massive sell-off of these different properties because of a lack of affordability, for that reason alone, I don't think people will do it in most areas or most communities. Now, there is one group of people that could see a major pinch, and that group of people are those who have recently retired or have been retired for a long time where their banks are simply not offering any other options. And these are the types of circumstances which are really sad, and I'm seeing them happen from time to time where they're having to make a decision as to actually selling that home or look at a reverse mortgage or some other type of solution. Thankfully, the people that I've worked with have had an option, typically a reverse mortgage, or they've opted to sell their property. But I can't imagine how many other Canadians who are retired and seeing their bank renewal come up at a rate of, say, 5% instead of 2% and seeing their monthly payments go up with a fixed income who are going to be squeezed in a tight spot. Again, the good news, most of these people have a substantial amount of equity in their properties, and so they could look at reverse mortgage or other types of solutions, but there is a level of concern in that circumstance, let's be honest. So all in all, in particular in this article, RBC specifically stated that their level of concern when talking to most of their Canadian borrowers is way lower than they initially expected. And I don't know if we see that actually increase or decrease based on going into 2025 and 2026 when we see more Canadians coming up for renewal, but that could be a sign that people are actually adjusting to the marketplace and making a conscious decision at this time right now to keep their home and of course decide not to do other things based on where they're at this time. So the question mark is, does that trend continue, or do we see a flush of homes come to the market in the middle of the year as we see more people decide that they can no longer make those payments? What's making this even more interesting is all of the news about interest rates decreasing. I've seen different predictions across the board with rates going down anywhere from 0.75 to 2%. And obviously we'll wait to see what happens as we could go through a little bit of a rocky year, but it would serve to suggest that this year could be an interesting one in real estate. On one hand, we have a massive buyer pool of people who have been waiting for a long time to get into the marketplace and hesitated last year when the market was coming down and rates were high. But on the other hand, we have a lot of properties that are actually likely to come to the marketplace and the potential of lower interest rates. So it seems like there's just going to be a big melting pot of a whole bunch of different things. And for anyone who tells you they know exactly what's going to happen, they're absolutely bonkers. But I'll tell you one thing which is true. Based on the information that I'm reading here and the information that has been produced, there are going to be some people who are going to be in pain. The first thing they need to think about is the different types of options at that renewal time, whether it be refinance, restructure, shopping around, or looking at different solutions. I've never had more inquiries for renewals in the beginning of the year than I have already at this time this year. And we're talking only a few weeks into 2024. Ultimately, moving forward into the future, what it looks like for 2025 or 2026 will be highly dependent on what happens this year and how low rates go. I'd be curious to know, what are your thoughts on the mortgage renewals? Do you think that will have a massive impact on the real estate market? Is this a blip? Will Canadians adapt, or will the market crash? Let me know in the comments below because I'd love to hear your feedback.